Welcome to Daily Mortgage Rates Live with the Mortgage Calculator. We're going to wait just a few minutes here to get started. We did put up the chat, so you can drop a comment there in the chat as you tune in. See some people already commenting in the chat as well. Today we are going to go through the live rates, and we're going to do a deep dive into VA loans. Just like we do every weekday, we'll do a deep dive into a different topic. Taryn, thank you everybody for tuning in. We'll get started in just a second here. All right, it looks like we are live on all of the different platforms here. So we should be good to go. Again, thank you everybody for dropping comments in there. As we go through the presentation here today as well, feel free to drop any questions you have in the comments, and we can get those answered for you. All right. Okay, looks like we are good to go, so we can go ahead and take the chat down, and we can go ahead and get into it. All right. So welcome everyone. My name is Kyle Hiersche. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. This is Daily Rates Live with the Mortgage Calculator. We are a correspondent lender that specializes in non-QM loans, but we also do regular conventional FHA, VA, USDA, and again, VA loans, which is the topic for today that we're going to do a deep dive into. We do this show at 11 a.m. Eastern every single weekday, so you can tune in. What we'll do is we'll see how the rates are looking for different programs, and then we'll do our deep dive into VA loans. So, Nick, if you're ready, let's go ahead and pull up our pricing tool, and let's go through today's live rates and see what it's looking like out there today.
All right, thank you, sir. Let me go ahead and switch my screen, and we will get started. So as Kyle mentioned, this is our pricing tool for our team of mortgage professionals. We have over 300 licensed loan officers. We're licensed in 22 different states for primary and second homes. And we can do our business purpose loans, which we love to do as well, our DSCR loans, in 44 states, so pretty much every state. If you'd like a full loan estimate with a breakdown of all the costs, please get with one of our team members. They'd be happy to send you a full breakdown. This pricing tool will show us our general prices and the APR, including all the borrowing costs, so we can look at the APRs. But if you'd like a full breakdown, please get with one of our teammates. So we're going to set up our pricing tool for our scenarios as we do every morning. We'll set a loan amount of $400,000. We'll set the LTV to 80% loan amount, 20% down payment. We will set the desired price to 99. That means we're going to tell the computer to find the best rate at one discount point in cost. Most of our customers are asking to buy down the rate a little bit in today's environment, so that is the typical request. We're going to compare our loan types, first conforming conventional, then we'll check out our FHA rates as we do every morning, and then we'll go into our expanded guidelines, aka non-QM, where we have over 5,000 additional loan programs using alternative income documentation. And we do not do the VA rates live because that's only for our eligible veterans. Luckily, today's topic is VA loans, so we will go into a deep dive of a few different options in there, but we don't do that every morning. And same with USDA, since that's only for properties in a USDA eligible area. We don't do that live, but if you are shopping in those areas, please let us know. We'd be happy to quote it for you with a full loan estimate. Now to start, we'll go with our conforming conventional first. We're going to set up all our scenarios: purchase, 30-year fixed loan, primary occupancy, single family, 1 unit, state of Florida, county of Miami-Dade. And for all of our demos today, we'll use an estimated FICO score of 760. And an estimated debt to income ratio of 40%. So using these basic settings, let's check out our conventional rates this morning. Nice. We love to see downward movement, right? So yesterday's show, kicking off Monday, the rates didn't really update much from over the weekend, but now that we've had the markets open, we see downward movement from yesterday. That's what we love to see. So right now we have a 6.375 rate for 0.875 discount points and costs, and a final APR of 6.547 here for this demo. Remember to key in on the APR. That allows us to compare across programs and get the actual cost there. So our conventional here, 6.547, slightly lower than it was yesterday. That's a good sign for everybody. Start working on those deals again and lock in those newer, lower rates. Now let's go to the next option. Typically, if a customer doesn't qualify for conventional for whatever reason, the next option is typically FHA. That allows a little more leniency on the credit guidelines, and it allows a higher DTI ratio where we can go to. But we'll keep everything the same in this demo so we can compare the same exact scenario with an FHA program. So it looks like about the same as yesterday for FHA. So conventional went down a little bit. FHA is about the same. So we have a 5.625 rate for 1 discount point in cost and a final APR of 6.227. Remember, FHA does have upfront and yearly mortgage insurance. So this APR takes all those costs into account. And we can see it's still slightly lower in this scenario than the conventional APR. So definitely check these out. In the past, FHA is typically a little bit higher at the end of the day, but now with the recent changes, FHA is lower. Definitely recommend all our customers compare FHA to conventional when they're out there shopping. And in this scenario, it's actually a tad cheaper. Now, if a customer doesn't qualify for conventional or FHA for any reason, many other banks and lenders don't have any other options, but that's where we love to come in at the Mortgage Calculator. We have our 5,000 additional programs under expanded guidelines, also known as non-QM. So if we set everything else the same, we do get one new option when we select our non-QM loans, and that's our income option. So typically full doc is what we use for conventional and FHA. That's 2 years of tax returns, what everybody's typically used to. So we would usually choose a non-QM program to take advantage of all of these additional income options, such as 1 year alt doc, 2 year alt doc are pretty general. Asset related, we did a show on that yesterday. That's no income or employment needed, just assets we're using. Business bank statements are popular programs. Investor DSCR is very popular for investment properties only. So we'll talk about that in a minute. Personal bank statements, 12 months is what we'll set up for our demo. We also have options for VOE, 1099, P&L, all kinds of different income options. But our most popular is going to be our personal bank statement 12-month program. And that's going to be for our self-employed borrowers. Many times our self-employed borrowers with 2 years of tax returns have various write-offs and different things going on in their tax return. And they either don't have enough income at all to qualify or need a little bit more income to qualify for the house they want. That's where we love to present these non-QM options, where we can actually use, instead of their tax returns, we'll actually use their last 12 bank statements here in this case to determine a debt to income ratio using their actual cash in the bank statements rather than their tax returns. So typically a self-employed borrower qualify for much more loan or qualify where they wouldn't qualify at all when they're using the bank statement. So these are solutions for borrowers that would not otherwise qualify. The rates are always a little bit higher on non-QM, but we love providing these options and these solutions. So let's check out our non-QM bank statements this morning. So I think that's about the same as it was yesterday, maybe a touch lower. We got some great options here. The top option that we find, 7% rate, 1 discount point in cost for 7.080 APR. Remember, the conventional, when we pulled it up a minute ago, was just over 6.5 APR. So non-QM using entirely different income method, very comparable, just about half a point higher on the APR. Definitely recommend anybody out there shopping that might need a little bit of extra income there, check out our bank statement options. Now, if we scroll down here, there's a ton of different versions of these programs using bank statements. So please get with our team. They'll navigate which one of these hundreds of options works best for you. Some of these may allow things like foreclosures, bankruptcies, things like that. When we get into the non-QM space, we can definitely get very flexible with all of these items. Now, before we pass it into Jose to go over our VA options, which are great for our primary homes, we always want to pull up our investment property rates. So we'll do our final 2 demos here. We'll set it as investment property, set the same exact scenario, 80% loan to value, 20% down, telling it to find the best rate at 1 point in cost. And we're going to simply compare our conventional investment property programs with our non-QM expanded guidelines programs. Remember, FHA, VA, USDA, not eligible for investment properties. So we'll simply start with these 2 options. Conforming, we'll keep everything else the same as our other demos. All we did was switch to investment. And let's see what investment property rates are this morning. About the same as it was yesterday, not as much movement here. So we have a 7% rate for 3.375 discount points and costs and a final APR of 7.255 on an investment property here under conventional. So many times our investors want to find an option at a slightly higher rate in order to reduce these discount points. 3.375 is a pretty hefty charge. Fortunately, conventional doesn't have many options. Even if we go up in rate here a little bit, here's a good option, 7.49 for 2.25 discount points. Our investors still ask for other options, and that's where we love to present our non-QM options, especially for investment properties. So let's switch back for our final demo today. Set this back up, 80% loan to value, 20% down payment, investment property. And when we select expanded guidelines non-QM for investment property, we actually get two options to fill out. First, we'll select our income verification. And the most popular option by far for an investment is going to be our DSCR program. That's because it doesn't require any income or employment from the borrower. Simply use the estimated rental income from the property we're purchasing to determine if that covers the mortgage expenses, the PITIA of the mortgage we're proposing. If the property rents cover the mortgage expenses, that's a ratio of 1.00 or higher, it covers. We even have options under one where the property doesn't quite cash flow over the expenses. So tons of different options. I'm going to leave this blank so we can show all the different options here in our demo, but we can obviously find different options based on the DSCR value. And the other thing we always set on our non-QM investment properties is a prepayment penalty. It's always standard to have a 3-year prepayment penalty. We can select 0 if we wish. That will cost more and limit our loan programs. We can also select 5 years. That will cost less, but less loan programs are available with a 5-year. So we always do 3-year as the standard option. So for our final demo today, let's check out our DSCR options. So we love to see these rates very near the investment property, right? You saw the conventional investment, 7.2 APR. We have a DSCR option here, 7.5 rate for 7.58 APR. So very comparable APR. Definitely recommend our investors check these out. And again, we solve the problem of the investor looking for a higher rate for less discount points. So 7.5 rate for 0.975 discount points and costs. Obviously, this solves multiple problems for our investors out there. So if you're looking for an investment property, always recommend to check out the DSCR options. And if we cruise down here, you'll see a lot of these have various DSCR ratios, various prepayment penalty amounts. So please get with our team. They'll navigate which one of these works best for you. Some of these at a little bit higher rates may allow bankruptcies, foreclosures. Some of these at a little higher rates may allow things like short-term rental income. So tons of different DSCR options that we have. Definitely have the right program for what you're looking for. Option is eligible, but now we're going to go into a deep dive in what veterans that are eligible, have their certificate of eligibility, can do with VA. So hopefully Jose has a couple cool, unique options. Obviously, we can do a standard loan, but I'm sure Jose has some tricks up his sleeve. So if you're ready there, Jose, you can go ahead and take over.
Sure. Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. A very big thanks goes out to all of our active military and our veterans who keep us safe. So our VA loans, very good options here, 100% financing. Keep in mind, this is for veterans and active military as well. On the VA loans, we can have a spouse as a co-borrower, but typically co-borrowers need to be married to the service member. Just wanted to throw that out there for our team as a little bit of knowledge. So we have multiple examples here. In our first example, which is a purchase of a 1 unit, I have this example exempt from the funding fee. VA loans are not subject to mortgage insurance. However, they do pay a funding fee, which is their version of an upfront mortgage insurance premium. On the first use, it is usually 2.3% of the loan amount, and it is financed into the loan amount the same way that the upfront mortgage insurance is financed in FHA loans. However, where we differ here is that VA does offer a benefit to our service members that have at least a 10% service-related disability. This information can usually be found on the certificate of eligibility that that you receive from the borrower or that you can obtain from the LGY portal when you are setting up your file. So I'm showing you first an exempt example, and then I'll show you a non-exempt examples for the same loan so you can see the difference in the payment. So this example here is for a purchase, and you will note 6.625 is giving a little bit of a lender credit, only $10. And you can buy it down all the way to 5.375, which is just a little bit above 2 points. Right. So this is our exempt example where no VA funding fee is due and not financed into the loan. So here you see $500,000 and loan amount here $500,000 because we do not have the VA funding fee thrown into the mix. So now I'll show you a non-exempt, same exact quote. You'll notice now that the payment is $64 higher per month. I'll show you the other example here. You see it's $2,800 at 5.375 for the payment. And here it's $2,864. Same exact loan. The only difference is the funding fee. So you see here, our total loan amount is $511,500, which is our 2.3% funding fee. So obviously it does make a difference in the payment, would make a difference in your qualification. So make sure that you clarify from the borrower if they have at least a 10% service-related disability. So my other examples here, I'm doing them as exempt. Now, as Nick says, I always like to throw a little twist in here. So here's our 4-unit twist, right? I like to make sure that everybody knows that with a VA, you can get a 2 to 4 unit for the same exact rate and cost. No add-ons, nothing additional. 1 to 4 unit pricing straight across the board is the same for all VA purchases because all VA loans are primary occupancy only. So you see here, same rates as the other ones. You can buy it down to 5.375. 6.625 is giving you a lender credit, and you can look at it anywhere in between. So now here we have our Earl refi, and in this case, our borrower is exempt as well. So the Earl refi is 100% financing VA to VA only. This does allow for the refi to be completed without an appraisal, without a credit report, and without income verification. That's similar to the FHA streamline option, right? So here we have 100% financing, but it is rate and term only under Earl. No cash out is possible. So it is a little bit more expensive in the rate. So you're looking at 6.99, having a little bit of a lender credit, and then you see how the rate progresses all the way down to 5.25%, costing you just under 2.5 points. And you'll see here, no addition. So actually, in this example, I did not click exempt on it. So we're having 516,500 on that. So, and now our 90% cash out refi. This is the maximum cash out refi LTV that is possible for VA loans, as the Earl, which is the 100% option, is a non-cash out option. Now, VA does technically allow, if you read into the VA guidelines, they do technically allow 100% cash out refi. However, most of the lenders, at least everyone that I've seen lately, does add their own overlay to cap the LTV at 90%. You may be able to find one outlier out there who's willing to take the chance to do that 100% LTV option, but those are few and far between. The standard would be 90% LTV on the cash out refi. And you're looking at here at 6.625, has a $761 lender credit. And here you can buy it down all the way to 5.125 at a cost of just over 2 points. So we are seeing a dip in the rates. And obviously, you do see at a 90% LTV versus 100% LTV, a little bit less risk, that the rate does get better, even though it is a cash out refi. So very good options here on the VA. And note that this 90% cash out refi, again, is available for 1 to 4 unit properties at no additional loan level price adjustments.
All right. Thank you, sir. Let me see if we can bring in. We got at least one question here that we want to take on. So Sean has a question for you. Can you go over 100 LTV when including the funding fee?
Absolutely. That's why I was showing you there. We had a purchase price of $500,000 and a loan amount of $511,500. So it
So in
does
that
allow you to
case,
do that.
it would be 102.3 LTV, right? Because it includes
Yep.
a 2.3 funding fee. So typically that would be the max.
That's the same as the FHA upfront mortgage insurance premium is financed into the loan. So you'll note that the base LTV is 96.5, but your full LTV is like going to be like 98 point something once you factor in the funding fee. I mean, the FHA upfront mortgage insurance premium.
And I don't see any other questions. If you guys have any questions, please drop them in. But I don't see anything else at the moment. Hopefully, y'all are VA experts out here. But if you have any questions, let us know. Let's go ahead and wrap it up, Kyle.
Yeah, absolutely. So any veterans out there, anybody know any veterans and the loan officers out there, you can connect with one of our loan officers at themortgagecalculator.com. We have over 300 licensed loan officers. We can do these VA loans in 22 different states. And as Jose showed, there's even multiple ways to do VA loans, right? So one of our loan officers can walk you through that. Now, we do this show every single weekday at 11 a.m. Eastern, where we go through the live rates, and then we do a deep dive topic every day. And today's topic was VA loans, and tomorrow we'll have a different topic, and so on and so forth. Looks like we do have a question here that we'll get to real quick if you want to bring that question in, Nick, and then we'll go ahead and wrap it up.
Question from LinkedIn. Are there certain requirements for condos?
You do have to get a condo questionnaire completed. It's not like FHA where it has to be FHA approved, but like any other condo loan, they do have to vet the condo. But they are easier to finance than FHA loans because FHA does require full approval of the building.
Another couple things too to highlight there, Jose. There's a couple other reports that VA does require. Remember, it always requires pest reports, well inspections, and some other things. So don't forget that while they are a little lenient on some things, they're a little stricter on some things as well, right, Jose? What are the other items? The well, the pest, any other weird?
Well, they're no, but they're going to have those same livability scenario that the property has to be totally habitable. So they're going to be looking at all the usual peeling paint, holes, any holes in walls, anything that they feel could pose a health risk hazard to the borrower.
Mm-hmm. So just pay attention to those. They're different, but very similar in concerns, I guess, right? On those what do you call them? Livability items?
Yeah. Yes, sir.
Gotcha.
All right. Thank you for the question. Perfect. Well, thank you, Nick. Thank you, Jose. That was great. Thank you, any veterans that have served. And you can connect with us at themortgagecalculator.com. We hope to see you all tomorrow at 11 a.m. Eastern for the next episode of Daily Mortgage Rates with the Mortgage Calculator. Thank you, everyone. Have a great day.
Thanks, everybody.
Thank you, everybody.